Clay Patton on the Rural Radio Network. Let's take a look at a commodity trade. And to do so, we're going to talk with Darrell Holaday, Country Futures in Frankfort, Kansas. Darrell, finally, after what seems like months of volatility, we get a little bit of a quieter week, but it seems like all this is just ahead of November, where we're going to get a lot of data both for the grains and for the macro market as a whole. What do you make of the trade?
Well, that's right. It definitely has occurred. You know, we've had a trading range really for a month, but at the same time, we've been, as your point is, we've been making moves to the top and the bottom of those trading ranges every week, which is a pretty wide range. What's happened is we've seen, to me, is we've narrowed up that range quite a bit, and it's been a much quieter market, less volatile during the week. It doesn't mean that there's no volatility. And as a matter of fact, once again, we saw pretty wide trading range in the wheat, but really the corn and beans, when you consider where we've been or what we've seen in the last year or even the last 6 months, you'd have to, in relative terms, you'd call this pretty quiet. Generally, it feels like we just kind of priced in those supply-demand numbers that we got in October. Of course, we got the new production numbers, and as you mentioned, we'll get a lot of data in November, and we'll get those in the second week of November. We'll get an update on those. Right. So now it's just kind of a battle, what I'd call a battle between the basis in the U.S. versus the weak export market. In other words, the very strong demand domestically, it's very good. The ethanol margins and the soybean crush margins are very good, especially those soybean margins in the crush margins in the Midwest, where they have a good supply, good yield, soybean yields. Now you get out here in the plains where the margin, where the beans weren't near as good, those processors really have to bid up for those beans to find the supply, and that's certainly trimmed their margin versus the Midwest. So the Midwest is really having a heyday. But we're also seeing really good demand for meal. You saw that on the price breaks this week. As a matter of fact, we saw the meal drift down there, and that even the January contract down to the under the 405 level, but came flying back on Friday, added about $10 a ton to that level. So the strength over that soybean meal, a little weaker soybean oil as we came to the close on the week, as we're seeing just a kind of a weaker sector there, I think tied to some of the macroeconomic effects. But once again, we had a lot of volatility in the equity side of things. We look forward, we're looking at a Fed that is expected to anyway raise the Fed discount rate 0.75 points, and that seemed like the market's kind of absorbed that right now and kind of looking past that. But sometimes you get to the reality of that, it's still an issue. But some decent numbers, a lot of earnings were out in the equity markets. And so we also had the impact of the dollar, which made a big break at midweek, went down to the 109.50 area, which is considered good support, but it bounced off of that. And so that's why the grains kind of found some strength at midweek when that occurred, but then backed off basically when it rallied back. So those are the overall factors I think we've got built in pretty well. We've found some equilibrium. And then at the bottom of all that, you have to then say, well, with all that, what else is there? And the one thing still that's out, the two other things that still are there is the Black Sea region, the uncertainty of that. At any day, that corridor could be gone. At the same time, you say, well, that's pretty supportive. Yes, it sure is. But at the same time, you have to factor in the reality that during October, it looks like Russia, for example, will export as much as 5 million tons through that Black Sea region. So they're moving. That doesn't even count the Ukraine wheat. So a lot of product moving through there, especially on the wheat side, especially coming out of Russia as they continue to. They're offering wheat out in the world market at about $100 a ton below U.S. prices. So obviously we're not going to see much of that business. And then the second thing, of course, is we're paying a lot of attention, of course, to the South American corn and soybean crops, basically Brazil, which is all off to a great. They've had plenty of moisture, very early planting. Conditions really couldn't be any better. Obviously, you've got the long growing season yet. Not the same is not true for Argentina, which has been dry. We did see some key areas get some rain this week, but it'll likely turn dry in the next couple of weeks. What's important to remember about Argentina is their critical weather really is more in that late December, January, and February. There are a lot of things can get better or worse going forward. So that just led to kind of a back and forth equilibrium type trading range market this week. On the week, December corn down 3 at 681, March corn 4 lower at 687, November soybeans down 8 at 1388, January soybean contract down a nickel at $14 even. December Kansas City wheat down 23 on the week at 925. That was the heavier sector on the week, especially late in the week as the wheat gave up ground. And I think a lot of that tied to the fact the corridor is still moving a lot of wheat. And secondly, we've been seed can at least see some better moisture better weather pattern, more favorable weather pattern for the plains and the Midwest. And there's areas in the Midwest that grow soft red winter wheat that have become significantly dry. But I do think overall the pattern looking forward the next 2 weeks will take some moisture through that. On the December crude oil was up 285 on the week, closing at 87.90. The livestock sector got once again a pretty quiet late week, except for we did see some strength in the cattle futures early because of the anticipation of higher cash, which we did. We got a lot of that built in, and the hogs had hung on for a long time and had been kind of moved to counter seasonally on the future side of things, because the index had held up quite well to 92 to 94, but we had the market kind of fall out of bed on the future side on Thursday as a lot of those index numbers started to decrease quite significantly. The product got kind of sloppy in the last half, and the numbers are going to increase seasonally as we anticipated, and we saw a big sell-off in the hog futures on Thursday with a little bit of recovery on Friday. But overall, still somewhat of a quiet trade. This is like to get back on the cattle. The cash market was 2 to 3 higher. Good packer demand. Record slaughter days, if they hold up, Wednesday and Thursday, 129,000 a day are both numbers we'd never seen before in the U.S. on an individual day of slaughter, inspected slaughter. We'll see whether they get changed as they come up with the actual numbers in a couple of weeks, but those numbers are not bearish as we continue to move through cattle. Good demand for the beef product. It moved higher all week. The wholesale choice continued to do that. As once again, overall choice fed cattle supplies certainly in a window here where they're fairly tight. On the week, October cattle 150.37 down 10. December cattle up 57 at 153 even. November feeders 177.87 down 47. January feeders unchanged on the week at 180.37. December hogs down 302, closing at 86.10, and the February contract down 167 on the week, closing at 88.85.
And that is Darrell Holaday, Country Futures, Frankfort, Kansas, with a look to your weekly commodity trade, and catch us every weekend on RuralRadioNetwork.com as a full-length podcast. Do remember, trade futures and options involve risk of loss, may not be suitable for all investors. Do consider these risks before investing. Learn more at countryfutures.com.